There's never been anything quite like Bitcoin. Truly, we are in uncharted waters. No asset in history has appreciated so rapidly. Therefore, Bitcoin is in a class of its own. Thus, we can expect it to behave differently than what we're used to. People often say that Bitcoin is a store of value, or digital gold. But I believe at this stage of Bitcoin's development process, Bitcoin's most important feature is that it's still the creator of value in the cryptocurrency world. And let me stress, price is not equal to value. The price of water is cheap, but it's pretty valuable. I mean, we die in about 3 days without water. If water suddenly became scarce, its market price would skyrocket. The market decides on price, but the value of something lies outside of its price. In the same way, the value of Bitcoin has nothing to do with its exchange rate. People will try to objectively value Bitcoin using statistical models, or they'll try to subjectively predict what Bitcoin will be by a certain date. I think the truth lies somewhere in between. Let's go through some of the ways that people look at Bitcoin's price, dispel the credentials of self-titled experts who throw out crazy predictions, and try to better understand how to anticipate the future of our cryptocurrency market. Welcome to ReadySetCrypto. This is your brain on blockchain. So there's a quote from Satoshi that's really stuck with me over the years. A lot of people automatically dismiss e-currency as a lost cause because of the companies that failed since the 1990s. I hope it's obvious it was only the centrally controlled nature of those systems that doomed them. I think this is the first time we're trying a decentralized, non-trust-based system. I think Satoshi was right on. This is something new. Inspired by old attempts in technology, yes. But the aggregate is something we've never seen before. Hopefully this drives home how the price of Bitcoin is the least interesting thing about it. Instead, the value of Bitcoin is more important, which is its command of a space unlike any other. When you truly understand the technology, you'll realize its true value. When talking about the market, I think people mistakenly relate the price of an asset to its value. So with that noted, it's all well and good to look at past results and extrapolate future predictions. But how can we do that? After all, Bitcoin is set to disrupt a $9 trillion annual market for electronic payments, a $24 trillion annual e-commerce market, a $574 billion annual remittance market, a $2.3 trillion hedge fund market, a $7 trillion gold market, a $4.5 trillion cash market, and a $16.7 trillion offshore deposit market. So how do you value something like that? Now, when defending Bitcoin's value, the common rhetoric is to talk about speculative value versus utility value, or to talk about scarcity, or to talk about block halving, or to talk about Tether is inflating the price of Bitcoin, or to talk about how there will only ever be 21 million of them, and how they're essentially the first piece of digital beachfront. I think there's merit to each of those valuation methods, whether good or bad. But if we want to be more empirical, more hands-on, I think it's relevant to talk about how you can value something that you can never hold, like traditional fiat currency or gold. So let's go through some of the methods people use. As a note, this video gets pretty heavy with the math and statistics, but I'm only referencing them as a means to illustrate what they're talking about. When you really break it down, it's not too hard to understand, and I'll do my best to help you. So one method I see people use to predict Bitcoin's price is Monte Carlo. Basically, in a Monte Carlo simulation, we assume that the future behavior of a price of an asset will be similar to its past behavior, and we generate a lot of random versions of that future, called random walks, similar to the past. That's done by taking random samples from the past and stacking them together to build each one of those random walks. The essential idea is using randomness to solve problems that might be deterministic in principle, such as what will the price of Bitcoin be in a year? To build each of the random walks in our simulation, we'd take random samples from daily returns from 2010 till today, add one to each of those samples, and then multiply them cumulatively until December 31st, 2018, or whatever your price date is. Then we'll multiply the current price of Bitcoin times the values of the random walk to get the simulated future prices. The important step is that we'll do this a ton of times, maybe 100,000 times. And at the end of the year, we'll see the distribution of the final price for each of those random walks. Now, our ending price is most likely going to be in the middle of the bell curve that we generate. To find that price more precisely, we could do several things. One of them is simply calculating the 50th percentile of the distribution of final prices. It's important to note that this estimation doesn't have to be taken to the letter, and it's better used as a way to find confidence intervals on where the future distribution will be. In this case, starting from the beginning of 2018, an 80% confidence interval for the price of Bitcoin by the end of 2018 would be between $13,000 and $271,000. But again, this is simply throwing darts at the board. A lot of darts, yes, but at the end of the day, this is simply using past results to predict future ones. It has no bearing on actual events, actual market movement, and the actual way things play out. Furthermore, it instills a blind sense of confidence that often leads to disappointment. Running a Monte Carlo simulation at the beginning of 2018 would tell you that the 50th percentile price is $58,000 per Bitcoin. This does not mean that it's the most likely to happen. It's simply in the middle of the guesses that we made. For a bit more granular and grounded of a prediction, we can use the Hayes and Wheatley econometric models. On one side, the Hayes model predicts a price of $55,000 for Bitcoin by the end of the year. That's a very bullish forecast, and for a good reason. It focuses on the supply side of the Bitcoin market, which is expected to grow at an ever slower pace as it gets closer to the limits defined in its code. It notes that Bitcoin mining difficulty will increase at a 7% monthly rate, whereas the last 2 years the rate was 14% monthly. On the other side, the Wheatley model predicts a price of $2,300 per Bitcoin by the end of the year. That's a very bearish forecast, and for good reason too. The model focuses on Bitcoin use, that is, on the demand side of the Bitcoin market. And Bitcoin demand has only been growing slowly, as evidenced by a recent Gallup survey. It notes that transactions per day will increase at a pretty steady 2% per month. So these two models paint a very different picture. They use actual metrics we can measure to value Bitcoin. You'll find that it's a very popular way of trying to pin down exactly what Bitcoin is worth. So let's look at Bitcoin from a different perspective to try and value it: the network effect. Now, in the 1980s, Robert Metcalfe, the inventor of Ethernet, proposed a formula. The value of a telecommunications network is proportional to the square of the number of connected users of the system, or n squared. Now, since its inception, Metcalfe's law, as it's now known, has become an influential formula for studying network effects and valuing online networks. According to the logic behind Metcalfe's law, n squared is the number of potential connections between users of the network. And in reality, there are limitations to the number of useful connections one user can have. Think of Facebook, for example. You only have so many friends as connections on there. This relationship is based on the so-called network effect, a positive effect described in economics and business that an additional user of a product or service increases its value to others on that service already. Going back to my Facebook example, you wouldn't be using Facebook if no one else was on there that you knew. Given that the price correlates so closely with transactions or active addresses, we can correlate current network usage to current price. To do so, we'll compute a price to Metcalfe ratio, or PMR. Such a ratio may be somewhat analogous to a price-to-book ratio in equity analysis. The idea here is to study the relationship between the price or value of a crypto asset and its fundamentals, as suggested by network usage. This type of ratio analysis is gaining popularity, with network value to transactions, or NVT, being the most widely studied. Unlike the PE ratio, the NVT denominator does not represent earnings, since digital currencies don't have earnings. Instead, the NVT ratio measures price against the utility or goal which investors seek in a cryptocurrency, namely store of value and medium of exchange. So essentially, Bitcoin's NVT ratio compares network value to network use. Analysts posit that these should track each other closely, and in the majority of cases they do. For all its merit, the NVT ratio still has two large drawbacks: philosophical and practical. Regarding the philosophical or fundamental logic of the ratio, we are inherently assuming that the transaction value of the Bitcoin network is a proxy for what people care about. We are implying that this is how Bitcoin derives its fundamental value or utility. The thought of Bitcoin as a payment network is increasingly difficult to defend. Its use of a store of value and speculative investment, and the fact that it keeps rising in price, is what currently excites people. So next, let's look at a heuristic-based relative valuation. Now, heuristic-based valuation methods are the simplest to understand, and they are some of the first methods utilized in the space. For example, you could estimate that Bitcoin would take 10% of the safe haven asset market from gold in the next 5 years. Given that the entire stock of gold is currently valued at 7 trillion, then 10% would imply a total valuation of 700 billion for Bitcoin. This valuation method is easy to understand and simple to implement, but has a number of weaknesses. First, it's not very objective, instead relying heavily on subjective estimates. Second, it requires the crypto asset to have a relatable asset in the current economy. This relatable asset also has to represent a reasonable gauge of its potential addressable market size. Essentially, do people want to give up gold for Bitcoin? Next, we could also look at a production cost-based model. This involves calculating the cost it takes for a Bitcoin miner to produce 1 Bitcoin, and then simply assuming that to be the fair value. This inherently implies that Bitcoin mining is a perfect competitive market where the marginal revenue of market participants equals their marginal cost. Thus, by solving for marginal cost per Bitcoin, we can find the marginal revenue per Bitcoin, i.e. the price. While Bitcoin miners do export an identical product, and are price takers for the most part, there are very clear economies of scale present. These economies of scale, due to the proliferation of high-cost, specialized ASICs, has led Bitcoin mining to become much more centralized among a few core players. So unfortunately, this is a flawed model as the Bitcoin mining market is not a perfectly competitive structure. So in summary, I think it's very apparent that there are multiple ways to value and predict Bitcoin's price. Again, what I think many of these models fail to take into consideration is the sheer importance that Bitcoin plays in this market. For all intents and purposes, Bitcoin is cryptocurrency, and cryptocurrency owes its start to Bitcoin. There would be no cryptocurrency market without Bitcoin. Furthermore, it is the default reference pair for this market. That is slowly changing as more stablecoins and alternative reference pairs, such as Ethereum, Ripple, and Litecoin enter the market, but for the near term, Bitcoin is very much a part of this market. As it stands, Bitcoin is the only crypto asset with futures products. Bitcoin is the only crypto asset with multiple exchange-traded product applications pending with the SEC, and Bitcoin is the only crypto asset that most people on the street know about. If your intentions are for the long term, then hold. If you are short term, then you should stay current with error components and find methods to execute. Lastly, if you're attached to money, stay away from crypto. This is a very volatile market that is not suited for the very emotional. What I've noticed is that when the market consolidates into Bitcoin, it usually predicates a bull run. We saw this prior to all 4 of the last major bull runs. And as it stands, Bitcoin is now at the highest market dominance since December of 2017. So hopefully this video helped you better understand how people might try to value a speculative asset such as Bitcoin, and how tough that really is. If nothing else, hopefully you should take away from this video how ridiculous it is to try and predict Bitcoin's price by a certain date with any degree of certainty. I should know, I did the math. And that's it for this video. Thank you so much for watching, and please consider subscribing if you haven't done so already in order to continue to see high quality cryptocurrency analysis and advice. Don't forget to hit the bell right next to the subscribe button in order to be notified when we put out a new video. Also be sure to watch some of our other videos and visit our website where we've got more free cryptocurrency education, a free intro course, a free book, and a free newsletter. So definitely check us out. Thanks again for watching. This has been ReadySetCrypto, and I'll catch you in the next one. Cheers.